Take a look at shares of Zoom Video, indicated up about 1.5%, actually recovering from an after-hours decline in the stock. The company posting better than expected revenue and issuing upbeat guidance, even as more people return to the office. Joining us now is Tyler Radke, software analyst at Citi. Tyler, good morning.
Good morning. How are you?
Good, thanks. The big question surrounding this stock, a lot of the stocks like them that were huge beneficiaries last year, is just exactly how much of a pull forward of demand, how much of their total eventual addressable market have they now gotten to, and what's the deceleration going to be looking like, if any? Any clues in the numbers and the guidance where you can now kind of handicap all those things?
Yeah, absolutely. I think this is kind of the poster child of a tale of 2 years. I mean, Zoom had an unprecedented 2020. You saw growth north of 300% year over year at a multi-billion-dollar scale, essentially the fastest growing software company we've ever seen in history. If you look at the numbers for the back half of this year, by Q4, that growth is expected to decelerate close to just 20% a year, which would put this in kind of a more of a typical growth software company that you see, like the likes of Salesforce or a Workday. And so, our view is just that the stock's multiple may have a hard time correcting, as growth slows down and this kind of moves from a hyper growth stock to more of a growth at a reasonable price stock.
Right. So we're talking about a stock that's still trading, depending on the numbers, 70-ish times forward earnings. Where does it ultimately settle at, and how quickly do you think it could grow into that valuation?
Yeah, so I think that over time, investors are likely to triangulate on where this trades on free cash flow. So if you just look at the forward free cash flow multiple, Zoom trades at around 60 times, a little north of 60 times. The Salesforce, ServiceNows, Workdays of the world, those trade around 30 to 40 times. So we think that as growth decelerates, that multiple may have to recalibrate, which is why we are neutral rated on the stock.
There's a lot of talk about, trying to create a next act for Zoom, whether it's, an app store or different products, the kind of the phone solution. Is any of that going to be moving the needle enough to change the overall story in terms of, what's happening with the subscriber growth trends?
Yeah, so there's definitely some interesting things going on at Zoom in terms of new products. You've seen Zoom Phone off to a really good start. They've announced a number of marquee wins with tens of thousands of seats. Very, very impressive results. But I think the challenge is this company is pretty big, right? I mean, we're talking about a $4 billion revenue base. When new products are just starting off, almost no matter how successful they are, it just gets really hard to move the needle on a company that big. We think Zoom Phone, while it is growing much faster than the overall growth rate of the company, we still think it's less than 5% of the total company. So it just gets tough for those new products to move the needle.
I know you also cover Docusign, which seemed to be in a very similar category. In fact, the stock charts, with Zoom, different magnitudes, but the exact same shape. So people seem to trade them as pure stay-at-home, work-from-home type plays. How sensitive are they going to be to what we actually see in terms of the percentage of people going back to the office and intensive usage of work-from-home type solutions? I mean, there's some school of thought that says nobody's going to cancel a Zoom subscription just because people are working 3 or 4 days a week in the office.
Yeah. So I would say that despite the similar stock charts, that Docusign is actually in a different camp than Zoom. I think as the world reopens and obviously kids go back to school and businesses return to in-person activity, there is more risk that there is some elevated churn among Zoom licenses. And I think just the increased demand levels that they saw last year essentially pulled forward a ton of future growth. I think if you look at Docusign, I don't know about you, but I don't look forward to signing paper-based agreements ever again, right? I think that future is here to stay. We're not going back to paper, where we may be going back to in-person meetings. And Docusign at their most recent analyst day, essentially committed to growing at above COVID levels or above pre-COVID levels for the next 3 to 4 years, So I think there's just more sustainable growth drivers at Docusign. They, like Zoom, are kind of the leader in the category. But I just think there's still so many paper-based, inefficient processes that can be digitized over the next several years as organizations pursue broader digital transformation.
Shepard Smith here. Thanks for watching CNBC on YouTube.